RRSPs are one of the best-known retirement tools in Canada. But simply having an RRSP does not mean you're automatically using it efficiently. The same account can be extremely useful in one situation and less attractive in another. And some RRSP mistakes are obvious because the CRA sends you a bill. Others are harder to notice. They can show up through unnecessary taxes, avoidable withholding, poor account selection, or years of missed compounding. So let's walk through 4 common RRSP mistakes, why they happen, and what Canadians should understand before deciding what to do instead. This video is for educational purposes only and is not personalized financial, investment, tax, or legal advice. The first mistake is assuming that an RRSP should automatically receive your next investment dollar, simply because RRSP contributions can generate a tax deduction. An RRSP contribution can reduce your taxable income. Investment income can generally grow inside the RRSP without being taxed as it accrues. But withdrawals are generally included in taxable income later. That means one important part of the RRSP decision is the relationship between the tax benefit you receive when claiming the deduction and the tax burden you may face when eventually withdrawing the money. If someone receives a deduction while facing a relatively high marginal tax rate and later withdraws the money at a lower effective tax rate, the RRSP can be particularly valuable. If the reverse happens, the advantage can be smaller. And if the tax rate is roughly the same on contribution and withdrawal, the comparison with a TFSA becomes more interesting than many people realize. Using equivalent pre-tax dollars, the RRSP and TFSA can produce similar after-tax results when tax rates are the same and the RRSP tax savings are properly accounted for. The major difference is when the tax is paid. With a TFSA, contributions are made with after-tax money, but investment income and qualifying withdrawals are generally tax-free in Canada. With an RRSP, the contribution may be deductible, investment income generally grows tax-deferred, and withdrawals are generally taxable. So neither account is automatically superior. The better choice depends on the investor's circumstances. For 2026, the lowest federal income tax bracket is 14%, and the highest federal rate is 33%. But those are only federal rates. Provincial or territorial income tax applies as well. That means an investor's actual marginal tax rate depends partly on where they live and how much taxable income they earn. This is why a simple rule such as, if you earn less than this amount, always use a TFSA, can be misleading. Suppose someone is early in a career and expects substantially higher income in the future. Keeping some RRSP deduction room available for a future higher income year may be worth considering. Using a TFSA during lower income years may also be attractive because the investor does not need an immediate deduction to receive the TFSA's Canadian tax advantages. But there are exceptions. An employer RRSP match can materially change the calculation. Giving up employer matching contributions simply to follow a generic TFSA first rule may make little sense. RRSP deductions can also affect other parts of the tax system because they reduce net income. And retirement withdrawals can interact with income-tested benefits. So the first mistake is not using an RRSP while earning a low income. The mistake is treating the RRSP deduction as automatically valuable without asking what that deduction is actually worth in the investor's situation. There is another useful detail many Canadians miss. Contributing to an RRSP and claiming the deduction are related, but they are not always the same decision. Someone with available room can make an RRSP contribution and in some circumstances carry an unused deduction forward to a future year. That does not mean contributing early and delaying the deduction is always the best strategy. It simply means Canadians should understand that the deduction does not necessarily have to be claimed immediately. The second mistake is much more mechanical: overcontributing. You may hear that the 2026 RRSP limit is $33,810. That number is real, but it is easy to misunderstand. $33,810 is the annual RRSP dollar ceiling for 2026. It is not automatically the amount every Canadian can contribute. An individual's RRSP deduction limit generally depends on unused room carried forward from previous years, plus the lesser of 18% of the previous year's earned income or the annual dollar limit, adjusted for items such as a pension adjustment. The number that matters to an individual investor is the actual RRSP information reported by the CRA. That is why checking a recent notice of assessment or CRA account information is so important before making a large contribution. Workplace retirement plans create another source of confusion. If an employee participates in a registered pension plan, the pension adjustment associated with that plan generally reduces the employee's RRSP deduction limit for the following year. That does not necessarily mean you can simply add your contribution and your employer's contribution together and subtract that number from your current RRSP room. The mechanics depend on the type of workplace plan. The safest approach is to rely on the RRSP deduction limit information calculated by the CRA rather than trying to estimate the effect of a pension plan from memory. Now let's talk about the famous $2,000 cushion. Generally, an eligible taxpayer can have up to $2,000 of excess RRSP contributions above the deduction limit before the 1% monthly excess contribution tax begins to apply. But this is not an extra $2,000 of contribution room every year, and it is not a $2,000 bonus deduction. If that amount is above the deduction limit, it generally cannot be deducted until sufficient room becomes available. The cushion is better understood as protection against a relatively small mistake, not as additional room that should automatically be used. Once the excess amount goes beyond that cushion, the CRA generally charges a tax of 1% per month on the excess amount subject to the rules. If the excess remained for a full year, that monthly tax could become substantial. And if an excess contribution return is required, the filing and payment deadline is generally 90 days after the end of the calendar year. Late filing penalties and interest can apply as well. So before making a large RRSP contribution, confirm the actual room. Do not assume the annual maximum is your personal maximum. And do not assume workplace pension participation has no effect. If an overcontribution has already happened, acting promptly can reduce the damage. But simply withdrawing money without understanding the CRA procedure can create additional tax reporting and withholding issues. Depending on the circumstances, specific CRA forms and rules may apply to withdrawing unused contributions. That is one situation where checking the CRA procedure or speaking with a qualified tax professional can be worthwhile. Now for the third mistake, oversimplifying where U.S. investments should be held. This is one of those topics that sounds easy until you look at the structure underneath the investment. Under the Canada-U.S. Tax Treaty, qualifying retirement arrangements can receive favorable treatment on certain U.S. source investment income. For a Canadian investor holding qualifying U.S. stocks or U.S.-listed ETFs directly inside an RRSP or RRIF, U.S. dividends can generally receive an exemption from the usual U.S. dividend withholding tax. That can make an RRSP or RRIF attractive for certain direct U.S. holdings. But now compare that with a TFSA. The TFSA does not receive the same treaty treatment for U.S. dividends, so when a Canadian resident holds a U.S. dividend-paying security in a TFSA, U.S. withholding tax will generally apply to the dividend. For a typical Canadian resident entitled to treaty benefits, that withholding rate is generally 15% when the appropriate documentation is in place. And because income inside a TFSA is generally not reported as taxable Canadian investment income, that foreign withholding tax generally cannot be recovered through a Canadian foreign tax credit. Here is a simple hypothetical example. Suppose a U.S. investment worth $100,000 distributes $2,000 of U.S. source dividends during the year. If 15% U.S. withholding applies, $300 would be withheld. The investor would receive $1,700 rather than the full $2,000. But this is where the usual internet explanation often goes wrong. It is not accurate to say that anything placed inside an RRSP automatically avoids U.S. withholding tax. The investment structure matters. Suppose an investor owns a Canadian-listed ETF inside an RRSP, and that Canadian ETF itself owns U.S. securities or another foreign ETF. Withholding tax can occur inside the fund before the distribution ever reaches the investor's RRSP. The investor may never see a separate 15% deduction on the brokerage statement because the tax can occur at the fund level. So the real rule is more precise. Holding qualifying U.S. securities directly inside an RRSP or RRIF can provide a U.S. withholding tax advantage. Holding a Canadian-listed fund that owns U.S. securities does not necessarily receive the same result. There is another wrinkle. In a regular taxable account, U.S. dividends are generally taxable in Canada, but a Canadian resident who reports the foreign income and foreign tax paid may be eligible for a foreign tax credit, subject to the applicable rules. Canadian dividends from taxable Canadian corporations can also receive Canadian dividend tax credit treatment in a non-registered account. Those facts can matter when designing asset location, but they do not create a universal formula saying U.S. stocks always belong in an RRSP, Canadian stocks always belong in a taxable account, and growth investments always belong in a TFSA. That is too simplistic. Using valuable TFSA room solely to avoid one kind of asset while ignoring expected return, risk, liquidity, available contribution room, and the rest of the portfolio can lead to a worse overall decision. A TFSA holding a U.S. investment can still be extremely valuable even if some U.S. dividend withholding occurs, because qualifying growth and withdrawals remain generally tax-free in Canada. Asset location is an optimization problem. It should come after deciding on an appropriate portfolio, not before. First, decide what investments make sense. Then consider which available account may hold each investment most efficiently. And when comparing structures, look through the ETF rather than focusing only on the ticker symbol. Now we come to the fourth mistake: treating the RRSP tax refund as free money. First, an important correction. An RRSP contribution does not guarantee that a check will arrive from the government. The contribution may create a deduction that reduces taxable income. Whether that reduction produces an actual refund depends on the investor's tax situation, including how much tax has already been withheld or paid. Consider a simplified example. Suppose someone makes a $10,000 deductible RRSP contribution, and that entire deduction effectively reduces income that would otherwise have been taxed at a combined marginal rate of 30%. Ignoring other tax interactions, the contribution could reduce that person's income tax liability by roughly $3,000. If enough tax had already been withheld from paychecks, that reduction might appear as part of a tax refund. For someone with different withholding or installments, it might simply reduce the amount of tax still owing. Either way, the economic benefit comes from the tax deduction. The refund itself is not a separate investment return, and it is not a bonus produced by the RRSP provider. This distinction matters because people can mentally separate the contribution from the tax savings. $10,000 goes into the RRSP. Then a tax refund arrives weeks or months later. The refund can feel like unrelated spending money, but if the person's objective is long-term wealth accumulation, reinvesting some or all of that tax savings can materially increase the amount working for the future. That could mean contributing to a TFSA if there is available room. It could mean making another RRSP contribution if there is available room, and that makes sense for the investor. Or it could mean directing the money toward another financial priority, such as high-interest debt or an emergency reserve. The important point is that spending the refund does not somehow erase the original RRSP contribution. The original contribution still exists, but spending the tax savings means that money is no longer available to strengthen the investor's balance sheet or compound for the future. So instead of saying, always reinvest every refund, a better question is this: what job should that tax savings perform? If the investor's priority is retirement saving, reinvesting it may make sense. If the investor has expensive consumer debt, reducing that debt may be more valuable. If there is no emergency fund, increasing liquidity may matter more. The decision should fit the financial plan. There is also a deeper lesson here. RRSP comparisons only work when the tax deduction is handled correctly. Imagine comparing an RRSP with a TFSA while pretending the RRSP deduction has no value. That makes the RRSP look artificially weak. Now imagine counting the RRSP tax savings as though it were free investment profit. That makes the RRSP look artificially strong. Both comparisons are wrong. The deduction is part of the RRSP's design. It needs to be included in the math. So those are the 4 mistakes. The first is using the RRSP automatically without considering the value of the deduction today versus the tax consequences later. The second is confusing the annual RRSP dollar ceiling with your personal contribution room and accidentally overcontributing. The third is applying overly simple rules to U.S. dividend withholding and asset location without looking at the actual investment structure. And the fourth is treating tax savings from an RRSP contribution as unrelated free money rather than deciding deliberately what that money should do. The broader lesson is that an RRSP is not simply an investment account. It is a tax-deferred structure, and tax-deferred does not mean tax-free. Money contributed can generally reduce taxable income when the deduction is claimed. Investment income can generally compound inside the plan without annual taxation, but withdrawals are generally included in taxable income later. For retirees, that final point becomes especially important. RRSP and later RRIF withdrawals can affect taxable income. Depending on the investor's circumstances, additional taxable income can also interact with income-tested government benefits and credits. So the goal is not simply to build the largest possible RRSP balance. The goal is to understand what that balance may be worth after tax and how future withdrawals fit with the rest of the retirement plan. For some Canadians, maximizing RRSP contributions can make excellent sense. For others, a TFSA may deserve priority during certain years. Many investors may ultimately use both. And for someone receiving an employer match, participating in the workplace plan may deserve attention before debating the finer points of RRSP versus TFSA optimization. The right answer can change as income changes. It can change when a workplace pension begins. It can change when contribution room changes. And it can change as retirement gets closer. That is why the most useful question is not, is an RRSP good or bad? The better question is, what is this account doing for me at this stage of my financial life? Understand the deduction. Know your actual contribution room. Understand what you really own before making asset location decisions. And treat any tax savings as part of the overall financial plan rather than an unexpected bonus. Get those 4 decisions right, and an RRSP becomes much easier to use for what it was designed to do. Help Canadians save for retirement while deferring tax until later. And once the RRSP is understood, the next question becomes just as important. Are you making the same kinds of mistakes with your TFSA?